Hello and welcome everyone to this live webinar brought to you by Global Derivatives USA. It is now only 2 weeks until the event in Chicago, so it's the ideal time to get ahead of some of the ideas being discussed at the event, including the topic of this webinar. I'm Ed Stapely, Editor-in-Chief of Global Derivatives, and I'd like to welcome Haim Bodek, Managing Principal of Decimus Capital Markets and author of The Problem with HFT. Haim will be giving an insider's perspective on the evolution of automated options trading and is participating on the high-frequency trading panel about challenging volatility regimes at our upcoming event. We'll be live tweeting this webinar, so you can join in the conversation using the hashtag GDWebinar. If you've got any questions during the presentation, you can ask these via the Ask a Question box on your screen. So do at any time, feel free to submit your questions there, and I will be asking those at the end. So that's all from me. Over to you, Haim.
Okay, thanks, Ed. Hello, everybody. All right, so today I guess we're going to kind of talk about really how the electronic trading business and options, as we said, has evolved. We're going to cover a lot about the systems and then end up where addressing the current regime and the current stalemate, as I like to call it. But let's just give you a little agenda here. Quick intro, then we're going to go over systems, a little bit about the strategies and execution, and then the evolution to today's state. Okay, so I think the place to start is really for those who aren't familiar with the U.S. markets, is that we have 15 exchanges, and you can see here we have market share and volume for September, and you can see there's some dominant players. SIBO is most notable, of course, primarily because of their extreme success in the index space and that franchise. But this is a lot of venues. I mean, the joke is, what the world needs is another options exchange, and it is a quite it's quite interesting how aggressive these new exchanges have been rolled out, and it's created a lot of complexity for people in the business in terms of different market models and fragmentation. Before I get into the details of the systems, I'm not sure if you guys can see this well. I thought I would just show you a kind of a typical screen. This is from the last option market making system that I've built, and basically what you have is you have all these derivatives, all these instruments. In this case here, we have the national best bid and offer, and we have theoretical values for options that we're trading, and those are in green. And the thing to appreciate about this business is that market makers need to price and trade and quote hundreds of derivatives per name, and now you have to multiply that by the 15 exchanges that we just saw in the previous slide. So, I mean, that's the thing to really try to wrap your mind around. What makes this business so different from cash equities is the sheer number of separate bids and offers that you have to maintain in the screen, and if you are mispriced at any one point in time, you can have significant severe losses. The kind of, I want to say, I'll call it the process flow. In this type of process flow would apply, outside of electronic options trading, but you can get a basic sense that we have electronic exchanges. We basically have a feedback loop, between our algorithms and the electronic exchange, where we are the market maker is calculating theoretical values, putting bids or offers in, either taking or posting through quotes. There's electronic trading risk controls. Those controls are looking at feedback in terms of risk that's put on the book, and also anomalies like the amount of trading that we do within short intervals. And trying to control and make sure we don't erroneously trade. And then there's, as part of this, there's also, automated price adjustment based on risk and inventory adjustment. And so what does the human trader do? Well, he's kind of on the sideline. Often, his interaction is kind of after the fact. And he would be basically adjusting parameters, or in some cases, if the machine stops trading or starts quoting very wide in a name because of some risk control, he'd go and look at it. That's kind of like the basic flow that evolved in the business. And I think probably the place I'm just going to start out here is kind of explain how things at least evolved in my experience. So I started whole trading in the mid '90s, and it was a quantitative options market maker, and this isn't exactly their system on the left there, but it basically kind of describes the pieces that or the components of their system that would be basically run by an upstairs trading desk. And what was happening in the U.S. at the time is that this kind of upstairs desk with this apparatus of an ability to process price feeds, come up with kind of estimates on the inputs to option valuation, and then volatility estimation, risk management, et cetera. It would all end up basically turning into this last box at the bottom of the big block on the left, which is called the electronic market maker. And at that time, electronic market maker was really thought of as a really theoretical valuations and theoretical bids and offers that would, in the U.S., be beamed down to an electronic handheld device. And what would happen is that the traders on the floors who had these devices would have access to all that information coming from upstairs, and they would have discretion. It depends on the firm, but they would have discretion to override or to trade around, to use that information to make trading decisions on the floor. In Europe, European markets had gone electronic, and you didn't have that anymore. And so, what I think the kind of area I focus on, which we call strategy, I guess, is really started out as a software that's purpose was to replicate in the electronic environment the floor trader who had the handheld. And when I say replicate here, you can see in my little diagram that at whole trading we literally just built new software pieces that literally had the same function in the architecture, where the execution engine you see on the bottom there is roughly equivalent, let's say, on Eurex trading DAX options, as the electronic handheld was in the U.S. trading S&P options. So that execution engine is really started out as in a way, kind of an expert system that would take in theoretical bids and offers and theoretical prices and do what traders had done on the floor, which was come up with real bids and offers in the marketplace. And in the previous diagram, I had kind of explained that the trade flows and basically the risk that's put on the book is one of the key things that a trader is processing and adjusting in conjunction with what we call automated risk management within the core system. But it's really I don't think people really understood until the business evolved a little bit more that floor trader was actually doing a lot of work to protect the firm from errors and from miscalibrations in the primary system. Okay, let me go back to that and also explain something about the 90s. And I probably should talk about the 2000s and on. I was planning on putting some charts for that, but I can just kind of talk you through it. In the 90s, markets were what we call dark, and that meant they were not continuously quoted in Europe. If people wanted quotes, they would have to put requests for quotes out and get a market back. Which so you could and some strikes or at the money strikes near term were quoted by some firms, but the systems actually at the time didn't have enough bandwidth to even really handle firms completely providing continuous bids and offers on every strike. So what happened is that because so many of the markets were what we say dark, or at least very wide in terms of the bids and offers that were out there. Brokers would basically test the market, put orders in, and try to find liquidity by putting an order in at a certain price, trying a more aggressive price, and and this is outside of a lot of normal activity, which is a prearranged crossing and all that. But what would happen is they were basically trying to find the price that one of these electronic trading engines would see as tradable. So liquidity was actually often provided by taking. The upstairs market maker would have what we called it a takeout machine. Other people call it electronic eye, a machine that would basically trade mispricings, and those mispricings often were brokers trying to find what we call the inside market or the hidden market that that would alert that would trigger us into trading with them. So that's the 1990s. Then 2000 in the U.S., the ISE rolled out first electronic options exchange in the U.S., and then we went through a period of 5 years or so of the transformation from floor-based exchanges to electronic exchanges, including a hybrid phase in the U.S. And the real push here was to have continuous quoted markets. So what you see in the 2000s is the competitive landscape kind of changes, and you move away from firms that are basically winning because they have superior valuation, and then you start having at least compared to historical, and you see firms quoting tight, compared to how it was done historically, and those tight quotations kind of reduced the premium that you really could get because the mispricings were now bound by the continuous quoting activity. So it was actually kind of good for, definitely good for markets and for liquidity seekers to have that information out there. And then it basically became the game quite changed because it became a game of scalability, of being able to maintain that many prices out in the market without getting picked off. So, if you are I'm trying to give you some kind of relative comparison here. In the late 1990s, your takeout engine, it can only do so many trades before risk controls shut it off. But by 2003, 2004, in a continuous quoting environment, you are putting out a couple 100,000 prices simultaneously across 500 names. And the amount of instantaneous loss or risk that you can have is is enormous. And there's actually quite famous, at least at the time, issue that happened on the Pacific Exchange. They rolled out a hybrid environment without really speed bump risk control kind of features. And one large market maker was trading the Qs, and they were using the future, and they basically got in their system a bad future tick, and it caused them to trade like $1 billion notional versus 3 other market makers. And, we looked at that. We weren't actually trading on the exchange because of because of my nervousness about the lack of risk controls. And, we looked at Bloomberg. We're trying to figure out what's going on, but the prices were completely whacked out there. Things were broken. And then there was this stalemate between that firm and the 3 other firms in terms of the counterparty. And they were, a couple hours went by when they were trying to determine if they were going to be able to price adjust or bust the trades. And, that's an entirely different environment than the 90s. So I think that's just something should be kind of aware of, is that the dimensions in which these businesses compete can be dramatically changed from low latency pricing to like kind of a mass throughput, and really electronic trading risk controls became really an edge at that point in time. I'm sure you're all aware of more recent mishaps like the Knight Capital event. So that went on, and then after that kind of period of transformation to electronic markets and continuous quoting, but that was all in nickel increments in terms of the tick size in the U.S. And then we had famously the shift to decimalization in 2007. And 2007 really created the beginning of call it the current regime, where decimalization created an environment where there were very, very small margins compared to historically that you could get in the option space, and we start seeing the option markets look more like high frequency trading markets in comparable to how U.S. equities markets are structured, and we'll talk more about that towards the end. But that's like your kind of overview where it really went through 3 phases, and there were really different winners and losers in each of these 3 phases. I'll just throw out, Interactive Brokers was one of the big winners in the continuous quoting kind of nickel environment, and they recently sold their unit to Sigma, and that gives you an idea of how difficult it was when things moved into this kind of low latency, high frequency trading oriented post-decimalization phase. So that's your kind of history in a nutshell. We're going to circle back to it. But what I'll get at here is that a lot of the, I think some people look at the space and they say, vanilla options, it's so, they're so easy to price versus, exotic products and all that. And I think what's kind of lost on people who are not in the space is that that this space is really concerned with different challenges. I mean, the most obvious and difficult thing I think one of the hardest things to do well in this business is to make the open every day. It's incredibly stressful. There's one moment in time, 1 second, where you are putting out hundreds of thousands, a couple 100,000 prices, bids and offers. Often your quotes are providing more liquidity than you see, or at least comparable liquidity, just for one quote in an option, than you see in the stock market. So when you make that open every morning, you are you're basically coming up with you're really a market maker, in that you are when you go out and you trade aggressively, you are setting the market, you are setting volatility levels, and you need to do that in a way that does not turn into a significant buildup of toxic risk. So to have think about the traders, right? The traders at that moment in time, we go into the market, right? You can have problems across all sorts of names, all sorts of situations. You can have, I have here, you can have data accuracy issues, dividends, rates. You can have so many different problems, and to have to address all of them within a few seconds creates an enormous challenge that can only be satisfied or addressed with automation. I'll give you, a little bit of some insight. I know it's insight, just some color. In the 90s, traders prior to the open used to make assessments and judgments on what volatility levels they would come in at the open at, and they would actually adjust the curves. And that became absolutely impossible in this continuous quoting environment. So you needed to have highly sensitive, adaptive strategies for recalculating volatility and for moving your markets quite rapidly as price discovery occurred in the morning. Another thing that I think maybe people are aware that the market data in the U.S. is. I've seen periods of time where it's 50 to 100 times more than the traffic going through the stock market. And I know things have changed back and forth now because high frequency trading creates so much data also in terms of cancel rates and order book death updates and all that. But there was definitely a time when the options market was in an entirely different tier of data processing requirement compared to the stock market. And we in our space had to put a significant amount of attention into managing and filtering that data, throwing away data that would trigger calculations that we didn't need to do, and that actually was the way you address it. You became very, very smart at when the algorithm was woken up, and what tolerances would result in a change. And that was quite different phase than the 90s when you tended to, you were able to calculate, you basically were able to recalculate every tick something, and it wouldn't create kind of a massive slowdown or getting bogged down. So I'm going through some, many of the challenges. I probably should move on a little bit here, but I've hit a couple of them, and I haven't even talked about the real area is how do you compete with other guys, right? It's not only you're trying to deal with these challenges, but you are trying to get the trade ahead of the other guy. You're trying to beat him to the trade. You're trying to make sure that when he's trying to hit your quote, that you can update your quote before his order gets there and trades against you. So you have to defend yourself against being picked off and update all your quotes while you're also being aggressive and trying to pick off other machines. And that's an incredibly time-consuming and difficult situation because these firms will get a leg up on each other, right? You'll have one day where another guy, his investments, he's rolled out new algorithms, he's rolled out speed advantage, and you have to immediately respond to it because you're bleeding, in those cases. So you have that, and then you also have all of the different features that exchanges have in terms of the market structure, the allocation rules, the different types of facilities to trade like auctions. There's the spread book, and there's in the options space, just like cash equities, there's constant evolution of fee structure and changes. And if you don't address those, you can get into a situation. Well, first of all, you can bleed to death just by not putting the right fee changes in, just like cash equities and HFT. So you have to be on top of all that. Anyway, the last point here, which is kind of actually think of it as the topic where really firms live or die in this space. We like to think that our models are what produce the edge, but as I'll explain later, models don't consistently produce edge unless they trade against customers and trade against liquidity seekers who are willing to give up that edge to you. I'll talk more about that, but order flow and order flow arrangements are, those components, and those are really business development. There is technology aspects also, but that dimension of business development and kind of creating a franchise of order flow a firm like Citadel, for example, has mastered that, and that has a lot to do with their success. Is probably the most. I mean, they are the most successful in this space now. All right. Now, again, I don't want to take up too much time here. So there are pieces of these systems that need to be put into place that pretty much all operations have. One thing I kind of want to highlight here is that option market makers have to be able to trade the equities and futures dimension of the options product, right? You are trading the delta of an option when you trade it. It's a complex instrument with different dimensions that you're trading, but the movement in the underlying is whether we don't like it, we like to hedge it out, but it is something that we have to do and have expertise in, which means we have to actually build up quite sophisticated equity and future trading systems, at least in the bare minimum, just to get the low latency pricing into our models. Now, one thing I want to say here, this is, I guess, the cash equities has also gone this way, but at the time in the going all the way back to the 90s, execution engines, which is really what my specialty is, really became typical software developer would look at these things and say, this is the most terrible design you could possibly come up with, an all-in-one process that wakes up and then responds by trading in the market, all within without thread contention, without handoff. But that type of kind of software approach is really what how firms, at least in the beginning, were how firms won the arms race. I mean, the arms race for us in the 90s was a new price comes in, we want to trade it. Other people see the same price, they want to trade it too. Whichever engine sees the price, processes the price, and responds to the price first wins the trade, right? That's the most obvious. The second type of call it takeout strategy you could have would be to is that the underlying moves, the stock moves. So remember, the stock is trading on a different exchange. So I see the stock move on one exchange. My valuation of the asset has now changed. Now I'm looking at prices in the option market that are now mispriced given the stock change, and now I got to hit the options before someone else does. So you have these kind of interesting arms race games, and these are very different than actually the cash equities. I know there are taking strategies in cash equities now that are highly speed sensitive, but a lot of the arms race in cash equities had to do with getting to the top of the queue and beating others, with these kind of microstructure order placement strategies. And in the options market, we have pure mispricing opportunities, which we compete for, and either somebody gets it, or I told you about the case where if it's my quote and it's mispriced, I want to update that quote before someone else hits me. But anyway, so I guess I'm kind of pointing out that we became focused on colocation, back in the 90s, and we would place our execution engines in data centers that had proximity to the exchanges, and then we still trade remotely, actually, from other from a main office. So, for example, you might trade. You might have a co-located option execution engine trading in Frankfurt when your office is in London. That was happened in the late 90s. Here, just giving you some color. I'm going to tear through this, but this was just kind of like a general view of how we do kind of architecture application design. This is some of the libraries that were in the system I built last. Blue are basically third-party libraries, and what I'm really showing here is that we build most of the software infrastructure ourselves from scratch. Usually, actually, I would even build the middleware, but we didn't for this build because of time-to-market considerations. But and used 29 West LBM there. Kind of regret that, but we won't get into that. Quick fix. I mean, most of our market links are actually direct API links. So, a quick fix would be used to communicate with a broker, some like non-latency sensitive destination. It's the only reason you see it there. Okay. Another thing I'll kind of point out, very important, is that in this space, you basically need to create a normalization. Call it heuristics or just something I call them building blocks, but basically components that kind of encapsulate and represent qualities or properties of the market making. And I'll just try to explain it. But one way to explain it is we have standardized bet sizes. We might call that standard size. And what that basically means is that every single derivative and every name would have a particular size. It would be calculated through some model, but a particular size that we as a market maker would be willing to buy or sell, that quantity at. And of course, price matters. So there would be, in connection with standard size, you might call it standard spread, which would be, my bid offer spread. So on one derivative, I might be willing to make a market where there's maybe 130 contracts bid and offered, around a theoretical value, and the spread itself actually shouldn't really be in price space. It should be in vol space, and then transform to price space. We don't have to really get into that, but the concept really is I'm willing to trade standard size at standard spread, and kind of a basic heuristic that you might throw in there is okay, if I'm willing to if I'm going to get an edge that is equivalent to making 1.5 times my standard spread, well, that means there's more profit in the trades. I should be willing to do more size, and I might be willing to do 2 times the size at 1.5 times standard spread, for example. So what I'm kind of getting at here is the algorithms don't deal directly with the properties of these options. The algorithms, the trading algorithms, are basically dealing with heavily transformed, variables which are that are proprietary variables that we invent to allow us to normalize and standardize the trading across the whole universe. So, what we'll see in our trade blotter is we'll see in edge levels, for example, if I see, I might have my system, maybe I'm not sure if you're following here, but I might have my system configured to not trade less than what I would earn if my spread was 0.7 times standard spread for any name. So if I see any, so as the trades are coming through, we'll have something called the edge ratio there. And the edge ratio basically says, what percentage of the spread did this trade actually make? And if I see something come across that says 0.3, I knew someone traded with me and my system didn't want to trade 0.3. The system was probably trying to update the quote, underline moved or whatever, and it was actually only 0.3 edge when someone traded with me, and I didn't get there in time. My engine didn't get there in time to update it, right? So these are the kind of ways that we interact with it, and what really is important, and why probably most operations have failed that have tried to do these kind of big builds. I think there were only 2 or 3 big builds in the options space from scratch in the 2000s that were actually successful, and there's so many banks that tried. And one of the things is people didn't really understand is that the developers that are building the systems have to actually kind of build these building blocks into the framework. They are the Legos, so to speak, for which we build up such systems. And because the systems are competing directly against one another, if we can do the same calculation, but if I have to go through more hoops or hops or whatever to get that calculation done, I'm going to be late to the trade, and I'm going to lose. And if you put two engines in the market and they trade with one another, the more accurate and the faster one will win. It is zero sum in this case. So it's something that I don't think is well covered here, but the actual design of the building blocks that you create these systems through is kind of key. And if you have the wrong framework, you just can't do it. When I say you can't do it, I mean you that would be an explanation of why a firm would need to leave the space, in that something changes in the market and their system cannot be adapted to address it. So it's only good as your building blocks. Now, I showed you earlier kind of what a takeout machine in the 90s would look like. Here, this is just you're not supposed to really, you don't really need to know what all these boxes are. But this was all the server processes in the last system I built. You'll see on the left the thing called D-star. That's an execution engine. So you can see the execution engine is still one focal point. It's not split up. It's an all-in-one process. That one there is connected directly to option feeds. It is listening to the system, just like the 90s, where it's acting against the option market, and it's not waiting for theoretical value. Let me be very clear here. It's not waiting for theoretical values. It's getting theoretical values in on a subscription basis. It's doing approximations, and it's reacting directly to the market. So that's kind of that process. And you can see on the right there that we start and you see on the right we have processes. These are processes that are portfolio management or having to do with various called proprietary models. And often those will have to do with positioning and risk accumulation. And that is kind of a different function than kind of low latency, immediate valuation and reaction. So there's kind of the natural division in the system between the analytics and kind of the HFT aspect of this business. Okay, moving on here. I'm going to probably be late here with time here, so I'm probably just going to have to just skip a number of these, but these are kind of the major areas of kind of development that you would have to build. Maybe one thing I'd like to highlight here is pass-through of trader-generated and model-generated liens. That's another important thing I probably didn't highlight with the building blocks, but that valuation itself needs to have a sensible way of incorporating all sorts of intentions. Like I may think this a security, an option is mispriced versus the market, but I may have too much risk on, or the future may have ticked in a direction which I have a model that would pass through kind of that market level of called future signal, and so if I do the trade now, it's going to go against me in the next 5 milliseconds or something like that. So you need a way, but then again, maybe because of the risk that I have on, maybe I have a situation where I'm trying to get out of a trade, and I have toxic inventory or something like that. So you need a way of taking positive, called edge and advantages, and netting it with in the kind of the value of adjusting your portfolio and getting into certain positions. You need to net all of those kind of pieces together. And maybe just to be explicit here, when the market, I'll just give you an example. When the market's going down, right? People, vol's going to be going up, and you're probably going to have a kind of a drive in your portfolio is probably going to be trying to buy volatility and to sell delta. But what you'll find out is you want the volatility, and it's going to be so much easier to buy volatility by buying calls because people are selling calls, right? So you'll have a situation where you need to price, is it worth the slippage that I pay by buying a call as the market going down to get into the vol position that I'm trying to target? And that needs to be kind of netted out in the calculations themselves. Okay, here's some notes. I mean, typically in these operations, I've always worked with a kind of pricing quant. My colleague Mark Shaw kind of covers this area. We both kind of overlap on called micro price, driver price, with the estimation of where the asset is, currently trading within the market microstructure. But he, my colleague is going to be working more on the pricing engine. So some of these topics here, is he's going to be quite obsessed with the ability of his pricing engine to basically, I'll say on a near tick-to-tick basis, he's going to need to reprice options, and it's a huge amount of calculation. So they spend a lot of time doing approximations within the pricing library. We do approximations, Taylor series primarily within the execution engines also. And he needs highly efficient calculations, and so there's kind of a lot of quantitative work that's done testing various implementations of option pricing models to see what their accuracy is and what the speed is. And there's a trade-off, and there's always times where there are particular regions where this model is failing, needs to be corrected, adjusted. So that's a big area for the quants. You have to be kind of a compute-oriented quant who's willing to do a ton of testing to do well in that area. I didn't talk much about volatility curves. This here is very, very basic view where I didn't want to really get into, we have volatility on implied volatility you have on the y-axis. X-axis, you have some choice in terms of the system you're building. I just have regular price here. But there is actually a lot of work that people do to try to figure out what the right normalization is for moneyness, and there's different types of approaches for what that axis would be. And the other aspect that people spend a lot of time on, which has a lot, is very important for actually automated. If you want to have a system where traders don't have to intervene and override parameters for the volatility fits, you need to have a parameterization of the vol surface that fits well. You have to have good curve fitting functions. They're selected well. You need to address non-arbitrage boundaries. And at the same time, it's one of the problems, sometimes when you address all that, you have a parameterization that's very difficult to understand and for the trader to manage. And also keep in mind the trader is going to often want to deal with curve adjustments. Here I'm talking about that last bullet there is just talking about the underlying moves. You want to have some automatic curve adjustments, but also traders want to target particular vega positions, certain parts of the curve when they and they may want to override because there's accumulation in their portfolio, and all of that is done often through doing adjustments to your theoretical vols, and that can be done by shifting the curve itself or by particularly addressing part of a region. So it's kind of a complex interplay between if you have a very poor or unintuitive function, it can lead to a lot of knockdown effects where you have a very difficult to manage system, which basically means you're going to accumulate bad risks, and your system is not going to be easily adjustable to get out of them, and it can turn into a complete nightmare if you don't address this area in kind of a practical way. And remember, you have all the performance issues and everything else. Okay, moving on. This is more my side of the fence here. I think I told you a bit about takeout strategies, where the two primary, there's others, but the two primary flavors are to use media or cancel orders and to auto hit mispriced option. Others to hit options when the underlying moves. More and more within the U.S. I think we're running out of time, right, Ed? No. Okay. More and more in the U.S., we have the issue of things like the special order types, order types that have particular features in the U.S. that can be used to get an advantage. Also, we have quoting strategies. Those have to be adapted per market. There are different allocation rules, different privileges, and you have to have different strategies actually to deal with each of the exchanges. And then lastly, I talked to you, I think I talked earlier about order flow, but one of the big kind of areas that, let's say, a large market maker like Citadel would work on is they would actually be primarily focused on getting into exclusive order routing arrangements where they can route retail order flow, but then they want to trade against it. And unlike equity markets, option market makers are not allowed to receive an order off exchange, see if they want to trade it, and then trade it. They're not allowed to handle the order. Once there are facilities which that type of process can be done, auction and internalization facilities on exchange, has to be communicated through exchange. And what happens basically is firms need to do well in that business of kind of order flow arrangements, need to basically optimize what we call the touch rates, the amount of intersection that they have with order flow that they have bought. And that basically is kind of strange because they're not allowed to know really what orders are coming when. So there's a lot of really sophisticated logic built into these routers that are trying to optimize or enhance these touch rates by being very, very smart about guessing where my prices are and where I want to send them. And it's kind of a controversial, but it's a whole area of algorithmic trading strategy. Here there's a lot to discuss, and we won't get really into it that much. But there are many facilities on exchanges, price improvement facilities, step up, combo order books. There's all these facilities that you can compete in and for order flow, on exchange to trade, and you have to code it all up and have good strategies for it, or you don't win the auctions. And one thing I probably spent too much of my life working on is really the delta hedging aspect of the market. I mean, option market makers are forever frustrated by cash equity markets, and the way that we hedge our risk and access cash market liquidity is really make or break for us. And for me, that was actually a big issue which probably led to my firm being shut down. Is to basically to be unable to extract liquidity from high frequency market makers in the cash equities at levels that would justify the edges that I was picking up in the option market. Okay, we're in the last section here. I'm going to skip some of this stuff, but I'll just say a few things. Most accurate theoretical value doesn't help you much if you can't get the trade. Speed matters. So in a weird way, once you are the master of the universe and you calculate everything perfectly, then you end up in my world where so what? So what if you priced it perfectly, there was nobody to trade with? Or how about the case where there's no dumb retail order flow to trade with? You're only going to trade against informed market participants, and you're only going to trade against them when they want to trade, when they're trying to be aggressive and find liquidity. Often it's because they're trying to get out of risk they don't want. So you can have a great model, but you can be put into an environment where your frequency of executing on the errors in that model is magnified. One thing, another bullet here, I say strategy improvements are short-lived, especially when the additional executions are against other machines. We always enhance our models, put in adjustments, we make money. Oh, we're so smart. We have this way to extract edge. Then a few weeks later, it's gone. And it's gone because the source of that edge was another market maker who at some point in time either adjusted his model so that he wouldn't pay that edge to you anymore, or he just widened out and decided not to trade. So a lot of the edges that that's why I said you have to trade with customers. Customers are the only ones who will continually give you these edges that you are extracting. And if you are trading against other market makers and they lose money from your trades, they will either exit the market over time, or they will adapt and stop paying you the edge. And and I think a lot of people don't understand that because there's so much focus on models to extract that additional edge without kind of realizing that that the source of that edge really matters. I mean, and this again, I don't want to hype Citadel up too much, but I would say they got it right when they basically put so much effort into locking down order flow sources. Okay, that's the last point here. Customer order flow is key. One thing that has been incredibly interesting about the last 7 or 8 years is the profound impact of equities market structure on options. I was actually kind of grouchy when it happened that cash equity exchanges bought the option exchanges, and they started rolling out their technology. That's actually convenient. I can use the same APIs and feeds and options that I use in stock. But then they rolled out their models, maker-taker pricing model, special order types, and certain kind of structural programs that or fee structure changes that really distorted, and really there was a long period where the equities exchanges were really trying to turn the option exchanges into kind of a version of equities. I remember a few years ago I saw a panel where an exchange exec admitted it was a failure and that there were distinguishing features that kept options, that you couldn't turn the options business entirely to HFT. But I will say that if it's gotten, this year might be the year it's been the closest. You have proliferation of lots of firms that are trading like HFTs, that are focusing on the short-term duration trades and getting in and out of risk over very short horizons. That used to be very difficult to even pull off because there weren't counterparties to trade with. I used to think of it as, or we used to refer to the business as kind of, we didn't flip inventory, we flipped risk, and we had lots of risk on the book, and we traded risk in a high frequency basis, not contracts. But now it's probably even getting as close as it can to this kind of high frequency scalping kind of universe. And I think Thomas Petterfee of Interactive was about that quite a bit before he closed down. I'm not, again, here's all your different market models. These are all, your algorithms have to be optimized for each one of these. It is an endless process, and, you're going to win on some places, you're going to lose on others. This is the center point of competition now. This slide here, I only got, I think, 2 more slides left here. This slide is really talking about how all these properties of the market that some people would say aren't really that sexy they're really where things have gone in terms of creating barriers to entry. So it's not about having the best model or even the best system anymore. With the exception of the arms race, which is an area where these barriers. But order flow relationships, fee structure, specialist rights, being able to approach trading regulations in a way that a trading firm can approach things with more liberal interpretation of regulations than a person at a bank would. These are the places where firms are getting structural advantages and creating barriers to entry, and it is a very difficult business to overcome these kind of structural these areas of structural edge and friction. Okay, so here we are on the last slide. So where are we today? Well, there is a big debate and a problem today. We've had decimalization. We've had the maker-taker model. Things have really gone maker-takers, if you've seen the previous slide. And that basically means that maker-taker markets are kicking back rebates, and that means that market makers can put better prices on those. They squeeze down the MBBO. But if I'm a liquidity seeker, I don't want to pay the taker fee. I would love to get, go to an exchange where I can trade for free, like Amex or Cboe as a customer instead of paying a taker fee. So what happens is order flow gets routed to exchanges that aren't at the best price. That's what's happening now. And when that happens, the orders will often go into these auctions. And the auctions are difficult for everyone to participate in. Certain firms will have, preferencing and prioritization, rights in them, and so what you see in the U.S. now is that the good order flow are basically going through these auction facilities, many of which are running on exchanges which are not showing the best price, and they're not really being exposed to the full market. And there are certain, kind of collective of liquidity providers who have access to these things efficiently, and the argument is, maybe these auctions are destroying or having a negative adverse impact on liquidity. You have if you are a customer now, you kind of have a difficult problem if you want to post orders. You can post them on a maker-taker exchange, but what's going to probably happen is that the good order flow is going to be routed away to the Cboe or the Amex, and it's going to go through some facility that you're not participating in. And then you're only going to trade when the market moves adversely against you. And that's what a lot of people are complaining about. But that's kind of where the business is here, and it really is a kind of stalemate. So that's that. This last slide here,
I do sort of butt in there.
Yep.
I do have to wrap things up more or less there, if that's all right.
We're all there. My last slide here just shows some of my books here. That's it.
Oh, fine. I'll let go ahead.
Okay, I was just going to say I have two books. I spent a long time, part of my career in the options space. For those of you who are familiar with my background, I started getting very, very quite involved in the regulation of HFT, and worked with the SEC on a variety of investigations and cases. So I have two books that have more to do with cash equities, market structure, and issues, in those markets. And these are some of those materials. And there's a book that talks about my option trading firm, Dark Pools, tells the story of the rise and failure of my firm. And then there's the Wall Street Code, which is a documentary I am in, that talks about my conflict with Direct Edge. So that's it. Ed, to you.
Thank you, Haim, very much for that presentation. That was really interesting. Unfortunately, we don't have time for questions live, but what we will be doing is passing over the questions that we have and encouraging further questions to people who listen to this. It's a recorded live webinar, so people can listen back to it and then submit questions, which we will get over to you to answer, and we'll get the answers back to the people who are interested in those as well. Just thanks again, Haim, and we will be seeing you in Chicago for Global Derivatives USA, November 1st to 3rd. For those of you listening, hope to see you there. But otherwise, should you be tuning in for further webinars, we'd love to hear your feedback for this one, and we'd also like to hear your suggestions for future topics as well. And there will be a survey that crops up at the end of this webinar on your screen shortly. So thanks again, Haim. Look forward to seeing you in Chicago. And thanks to everyone for joining us as well.
All right. Thank you.